They aren't buying the dip, they are selling the top. Right now, your average neighbor is celebrating because their 401k is up. They are at dinner parties, pulling up their brokerage apps, and bragging about their returns. They are chasing the AI hype and buying stocks like Nvidia because they have convinced themselves of a dangerous lie. It only goes up. But the smartest people in the room, the ones who actually built these companies, are quietly sprinting for the exit. I have spent the last week digging through SEC filings, the dense, boring legal documents where CEOs have to legally admit what they are doing with their own money. And the data is terrifying. In the last 12 months, the world's richest insiders, Jeff Bezos, Mark Zuckerberg, Jamie Dimon, and the Walmart family, have sold over $50 billion of their own stock. They aren't selling because they need gas money. They aren't selling to buy a new boat. They are selling because they know the party is ending. Signal number 1 is the sheer amount of cash they are hoarding. But signal number 13 is a specific recession alarm that has a 100% accuracy rating since 1955. This is the macro edit. Before we get to the list, you need to understand the game. In the stock market, there are two types of people: the insiders, who have the data, and the outsiders. That's you. When a CEO goes on TV, they are paid to be a cheerleader. They have a fiduciary duty to keep the stock price up. They will look into the camera and tell you, demand is strong, the consumer is resilient, and the future is bright. They will announce massive share buyback programs to artificially pump the stock price, luring you in. But when the cameras turn off and they log into their personal brokerage accounts, their actions tell the real story. Watch what they do with their personal wealth, not what they do with the company's money. Warren Buffett is the ultimate insider. He hasn't just stopped buying stocks, he is selling his favorite companies. He has sold massive stakes in Apple. He has dumped Bank of America. He is now sitting on a $382 billion pile of cash. Why? Because Buffett knows a simple truth that most retail investors forget. When stocks are expensive, cash is king. Cash is not trash when the market is overvalued. Cash is an option on the future. It gives you the power to buy high-quality assets at a 50% discount when the market eventually crashes and liquidity dries up. The billionaires are building a fortress to protect their wealth. You are holding a lottery ticket hoping for one last payout. Here are the 25 signals that prove the insiders are cashing out. Part 1. The Great Sell-Off. These first 10 signals track exactly who is selling. These aren't rumors. These are federal records. Number 1. The Bezos Blitz. Jeff Bezos has sold more Amazon stock this year than ever before, over $13.5 billion. Think about that number. That's enough to buy a small country, but you have to ask yourself, why is he selling now? Bezos isn't just a tech mogul, he is the owner of the world's largest data set on consumer spending. Bezos has access to real-time data on everything you buy. Every diaper, every laptop, every book, every cheap gadget. He knows if you are switching from brand names to generic. He knows if you are waiting longer to click checkout. If he is cashing out 5% of his net worth, it's a signal that he thinks the consumer is tapped out. He sees the recession in the shipping data before the government sees it in the GDP reports. Number 2, the Jamie Dimon first time. Jamie Dimon is the CEO of JPMorgan, the biggest bank in America. He is arguably the most important banker in the world. For 18 years, through the 2008 crash, through the European debt crisis, through the pandemic, he never sold a single share of his own stock. He told everyone he would only sell when he retired. In 2024 and 2025, he broke that promise. He sold hundreds of millions of dollars worth. This is critical because JPMorgan processes half of the credit card transactions in the United States. Dimon sees the bank accounts of half of America. He sees the credit card delinquencies rising. He sees the savings accounts draining. If he is raising cash after holding for 2 decades, it means he sees storm clouds gathering over the banking system that the rest of us are ignoring. Number 3, the Zuckerberg pivot. Mark Zuckerberg has sold over $1.1 billion in Meta stock recently. He is selling right as the stock hits all-time highs thanks to the AI hype. This is classic market psychology. While he tells you that AI is the future and that Meta is investing billions into the metaverse, he is using your enthusiasm to sell his shares at the highest possible price. In finance, we call this feeding the ducks while they are quacking. When the public is desperate to buy, the smart money is happy to feed them supply. He isn't betting against his company, but he is certainly betting that the current valuation is unsustainable. Number 4, the Walmart cash out. The Walton family, the heirs to Walmart, have been selling stock relentlessly. Walmart is the heartbeat of the working class. It is the bellwether for the average American family. When the economy is healthy, Walmart thrives. But the Waltons aren't buying more shares, they are liquidating. If the family that controls the grocery budget of America is selling, they are betting that a recession is coming. They are preparing for a world where margins get crushed and the consumer simply stops showing up. Number 5, the Oracle sale. The CEO of Oracle, Safra Catz, did something unthinkable. On June 26, 2025, she sold nearly $800 million in stock in a single day. This is not a slow diversification plan. This is a dump. When an insider dumps nearly $1 billion during a boom, it suggests they know the earnings won't live up to the hype. Oracle is deeply tied to enterprise spending. If businesses were truly booming, she would hold for the upside. Selling this aggressively signals that corporate budgets are tightening behind the scenes. Number 6, the Buffett bank exit. Warren Buffett loves banks. He understands them better than anyone. He usually holds them forever. But recently, he sold over $10 billion of Bank of America stock. This is a massive red flag. For Buffett to sell a safe, Dividend-paying stock means he sees a problem in the banking system that scares him more than the tax bill he has to pay. He likely sees the unrealized losses on bank balance sheets, the bad loans in commercial real estate that haven't been marked down yet. He is getting out before the truth is revealed in the quarterly earnings. Number 7, the insider ratio. This is the scariest number on the board. There is a metric called the Vickers ratio. It tracks how many insiders are selling versus buying. Historically, this ratio hovers around 2 or 3 to 1. Executives usually sell a bit more than they buy just for salary reasons. But right now, for every $1 of stock insiders are buying, they are selling $17.32. This isn't a trend. This is a stampede. We haven't seen insiders run for the exits this hard since the peak of the dot-com bubble in the year 2000. They know the valuations are disconnected from reality, and they are ensuring they aren't the ones holding the bag when gravity kicks in. Number 8, the private equity freeze. Private equity firms are the whales that buy and sell companies off the stock market. Right now, they are stuck. They are in a liquidity crisis. They can't sell their private companies because nobody can afford to buy them at these interest rates. When these whales can't sell their private assets, they are forced to dump their public stocks to raise cash. They are treating the stock market like an ATM because the rest of the M&A market has completely frozen over. Number 9, the NVIDIA divergence. Everyone is talking about NVIDIA. It is the poster child of the bull market. Retail investors are taking out mortgages to buy it, but the actual executives at NVIDIA, the people writing the code and building the chips, they are selling. They aren't buying the hype, they are locking in their profits. They know that the semiconductor industry is notoriously cyclical. It goes through massive boom and bust cycles. They know that trees don't grow to the sky, and they are selling into the mania while the public buys the narrative. Number 10, the 3-year streak. Warren Buffett has sold more stocks than he has bought for 12 quarters in a row. That is 3 full years. For 3 years, the greatest investor in history, the man who tells you to be greedy when others are fearful, has looked at the market and said, no thank you. He hasn't found a single major deal worth doing. That should tell you everything you need to know about how expensive this market truly is. I am tracking every single one of these SEC filings in real time. If you want to see exactly when Buffett, Bezos, or the Waltons make their next massive move, make sure you subscribe and turn on notifications. You do not want to be the last person to know when the smart money officially pulls the plug. Part 2, the warning signs. Why are they selling? It's not just a gut feeling. They are looking at macro signals that spell disaster. Let's break down the complex terms into plain English. Number 11, the Hindenburg signal. There is a technical alarm bell called the Hindenburg Omen. It flashes when the market is fractured. Here's how it works. The Omen triggers when a massive number of stocks hit 52-week highs and 52-week lows on the exact same day. This shouldn't happen. In a bull market, everything goes up. In a bear market, everything goes down. When both happen at once, it means the market is ripping itself apart. The big tech stocks are pulling the index up, but the average stock is collapsing under the surface. It just flashed red on October 30th, 2025. The last times we saw this signal this clearly, right before the 2000 crash and the 2008 financial crisis. It signals that the market's internal structure is broken. Number 12, the overpriced indicator. Warren Buffett has a favorite metric. He compares the total value of the stock market to the entire GDP of the US economy. Historically, the stock market should be worth about 85% to 100% of the economy. That is fair value. Right now, it is at 230%. Think of it like buying a house. If a house generates $50,000 in rent, you might pay $500,000 for it. That makes sense. But right now, investors are paying $1.5 million for that same house. The rent hasn't gone up, only the price has. Eventually, reality sets in. Prices always revert to the mean. And when they do, that 230% will come crashing down to 100%, wiping out trillions of dollars of wealth in the process. Number 13, the recession alarm. For 2 years, the bond market has been predicting a recession using something called the yield curve. This is the single most reliable indicator in financial history. Here's how it works in plain English. Think of a bank, like a business. A bank makes money by borrowing short, paying you interest on your savings, and lending long, collecting interest on your mortgage. Usually, long-term rates are higher than short-term rates, so the bank makes a profit. When short-term rates go higher than long-term rates, the curve inverts. Suddenly, the bank loses money on every loan it writes. So what do? They stop lending. They cut off the credit. When banks stop lending, businesses can't expand, payrolls get cut, and the economy runs out of gas. But here is the trap. The recession doesn't happen when the curve inverts. It happens when it uninverts. When the market realizes the economy is crashing, they rush to buy bonds, and the curve snaps back to normal. That just happened. The curve has uninverted. It means the system has officially broken, and the countdown to the crash has hit 0. Number 14. The generals versus the army. The stock market looks good on the surface, but underneath, it's rotting. This is a concept known as market breadth. Imagine an army marching into battle. If the generals, the big companies like Apple, Microsoft, Nvidia, are charging forward, but the army, the thousands of smaller companies, is retreating, you lose the war. That is exactly what is happening. The S&P 500 is hitting highs, but the Russell 2000, small companies, is struggling. A few massive companies are masking the pain of the broader economy. In a healthy market, everyone rises together. In a dying market, only the big guys stay afloat, until they sink too. Number 15, the Sahm rule. We are watching the Sahm rule. It is a recession indicator based on unemployment. It says that once the 3-month average of the unemployment rate rises by just 0.5% from its 12-month low, a recession has effectively begun. It is incredibly accurate because unemployment is a feedback loop. Once people lose jobs, they stop spending. When they stop spending, companies earn less. When companies earn less, they fire more people. We are currently sitting right at that trigger point. The labor market is softening, and history tells us that once unemployment starts to tick up, it shoots up like a rocket. Number 16, the failed rally. Recently, traders tried to push the market higher, and it failed. We saw a massive attempt to break out to new highs, but the volume wasn't there. In plain English, the bulls fired their last bullet and missed. This is technically known as a double top or a bull trap. It lures in the final wave of retail money before the floor falls out. Number 17, paying more for less. The PE ratio, price to earnings, is the most basic measure of value. It tells you how much you pay for $1 of corporate profit. Right now, investors are paying $28 for every $1 of profit. Let's use an analogy. Imagine buying a lemonade stand. The stand earns $100 a year in pure profit. A fair price might be $1,500, taking 15 years to earn your money back. But right now, the market is asking you to pay $2,800 for that stand. It would take you nearly 30 years just to break even on your initial investment. That is what the S&P 500 is today. It is priced for perfection in an imperfect world. Number 18, the hurricane insurance. The fear index, or VIX, is extremely low. The VIX measures the cost of options, which are basically insurance policies for stocks. When the VIX is low, insurance is cheap because nobody is scared. This is dangerous. It's complacency. It's like living on the coast of Florida and canceling your hurricane insurance because it hasn't rained in a week. The billionaires are doing the opposite. While the average person ignores the risk, the smart money is buying up all the cheap insurance. They are using this period of low volatility to hedge their portfolios, preparing for the volatility spike that always follows a period of calm. Number 19, the cash vacuum. The US Treasury has a massive problem: debt. To pay the bills, they have to issue bonds. They are refilling the Treasury general account. To do this, the government sucks cash out of the banking system. When you buy a government bond, you send cash to the government. That is cash that leaves the private sector. Every dollar the government takes is a dollar that can't be used to prop up the stock market. This liquidity drain is happening right now, pulling the rug out from under asset prices. Number 20, the suckers rally. We are in the euphoria phase of the market cycle. Retail investors are borrowing money on margin to buy stocks at record rates. Sentiment surveys show extreme optimism. This is the final stage. The wealth is being transferred from the weak hands, you, to the strong hands, the insiders. The insiders have sold the top to the public. They have distributed their shares to the crowd. Now, they wait. They wait for the sentiment to shift, for the panic to set in, and for the prices to collapse. Most financial channels won't tell you this because fear doesn't sell ads, but here, we deal in data. If you appreciate the truth and want to be part of the community that survives this, hit that subscribe button right now. It helps us keep the lights on and the data flowing. Now, let's talk about how to protect yourself. Part 3, the safety plan. The picture I just painted is bleak, but remember, crisis equals opportunity. If the insiders are selling stocks, where are they putting that $50 billion? They aren't stuffing it under a mattress. Here is their playbook for surviving and thriving during the collapse. Number 21, the government savings account. The smart money is parking their cash in short-term US Treasuries, or T-bills. These are risk-free assets. Right now, they pay about 5% interest, guaranteed. In a crash, stocks can drop 50%. T-bills don't drop. They pay you to wait. Why risk your capital in an overvalued stock market for a potential 8% return when you can get a guaranteed 5% without taking any risk? This is the calculation Buffett is making. He is sitting in T-bills, earning billions in interest, ready to deploy that cash the moment the market breaks. Number 22, real stuff. Notice that while they sell paper assets, stocks, they are buying real things. Bill Gates is buying farmland. He is now the largest private owner of farmland in America. Jeff Bezos is buying massive real estate portfolios. Zuckerberg is buying land in Hawaii. They are moving their money into hard assets. These are assets that cannot be printed away by the Federal Reserve. When the government inevitably prints trillions of dollars to bail out the system during the next crisis, inflation will return. Hard assets, land, real estate, commodities, hold their value when the dollar loses its purchasing power. Number 23, the crash insurance. Billionaires are actively buying put options. Think of this as car insurance for your portfolio. You pay a small premium, and if nothing happens, you lose that premium. But if the market crashes, these options pay out huge returns, often 10x or 20x the initial investment. This offsets the losses in the rest of their portfolio. They are hedging their bets, ensuring that even if the ship sinks, they have a lifeboat. Number 24, the sovereign pivot. This is a new, emerging signal. Even states like Texas and Pennsylvania are passing legislation to hold strategic reserves of Bitcoin and gold in their state treasuries. Why? Because they are losing faith in the long-term stability of the US dollar. They are hedging against sovereign debt risk. The US is $36 trillion in debt. The insiders know that eventually, the math breaks. Holding assets outside of the traditional banking system, like gold and Bitcoin, is the ultimate insurance policy against a currency crisis. Number 25, the ultimate weapon, patience. The final signal, and the most important tool, is time. Warren Buffett doesn't mind looking boring for 2 years. He doesn't care if people call him washed up because he isn't buying Nvidia. He has seen this movie before. He survived 1974. He survived 2000. He survived 2008. His plan is simple. Sell at the top, accumulate cash, wait for the panic. He knows that eventually, a liquidity event will happen. Forced sellers will dump high-quality companies for pennies on the dollar. That is when he strikes. He survives the crash so he can own the recovery. So, what should you do when the insiders sell $50 billion? The average investor reacts with emotion. They buy when they feel good, at the top, and sell when they feel scared, at the bottom. You need to invert that logic. 1. Don't fight the flow. The trend is your friend, until it bends, and the insiders are bending it. If Jeff Bezos is selling Amazon, do not take out a loan to buy Amazon stock. Don't think you know more about the company than the guy who built it from a garage. Respect the data. 2. Check your bag. Look at your portfolio honestly. Do you own the expensive, hyped-up stocks that rely on hope and future promises? Or do you own the boring, safe assets, companies with real cash flow, low debt, and moats that can survive a storm? Now is the time to trim the fat. Take profits on the high flyers and rotate into quality. 3. Build your war chest. Start saving cash now. Stop spending on things you don't need. The opportunity of a lifetime is coming. Recessions create more millionaires than any other time in history, but you can only participate in that wealth transfer if you have liquidity. When the market crashes, cash is the most valuable thing on earth. It buys you freedom. It buys you assets at generational lows. The billionaires are ready. They have built their fortresses. They have hedged their bets. Are you? The warning light is flashing red. The exit doors are jammed. The insiders have already left the building. I'll see you in the next edit.